Thank you for attending our Taxes in Retirement Today workshop. We hope that you found it informative. We know that we threw a lot of information at you, and if we had more time, we would have given you more. That is why we have created these follow-up webinars exclusively for those who attend our workshops. This gives us the opportunity to dive deeper into some of the topics from our live presentation and touch on others that time did not allow for during that presentation. And it gives you a valuable resource that you can refer back to in addition to the materials you received at the workshop. Of course, even after reviewing all of the resources we have provided, you may still have questions, especially specifically pertaining to your own unique circumstances. We encourage you to take us up on our offer of a complimentary consultation, where you can meet one-on-one with an advisor to ask questions and receive an analysis of your personal situation. If you have questions you'd like to ask prior to scheduling a consultation, please feel free to contact us via the contact information we have provided. We are glad that you have come this far in your quest to better your retirement and legacy. We are confident that by the end of our talks, you will be better informed about the challenges of retirement tax planning. Even if you have a lot of questions, you are closer to finding the answers you need. So welcome to our first follow-up presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Lauren Swan, and I am the Director of Business Development and Operations for Bay Harbor Wealth Management. I am presenting on behalf of Lance Scott, our President and Fiduciary Wealth Advisor, who was the presenter of our live workshop. Our goal is always to inform and educate our audience so you can understand how critical financial planning topics affect you and your family. This is important to us because we've seen many people make mistakes and pay more taxes in retirement than is necessary. When that happens, it makes our job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second to explain how this presentation will unfold. The presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you will see. To help you remember what we're covering here, I want to point you to the downloadable materials that were available to you along with this presentation. The page titled, How Tax Planning Changes During 4 Stages of Retirement is a summary of our presentation that you can refer back to as needed. Now, there is one other important point I need to reiterate. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRA, non-deductible. Money grows tax-free and earnings may be withdrawn tax-free in accordance with IRS rules. State taxes. This presentation references federal taxes. You may still face state taxes. Check with your tax professional. We are an investment advisory firm and do not provide tax advice. What we do is help people understand how the tax code and other rules could impact their financial planning and investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Now, let's warm up with a little tax brain teaser about Bill. Sounds like fun, right? So, after working hard for his adult life, Bill, 65, has finally retired, and he is going to more concerts than ever before. Bill has $42,475 in taxable income, which includes $25,000 of Social Security benefits this year. As you can see, Bill's $42,475 of taxable income puts him in the 22% tax bracket because it is more than $40,125 and less than $85,525. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much is he taxed on that extra $1,000? The logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22% tax. Simple enough, right? Wrong. He owes $407 in tax, a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes a $407 on that extra income. Shocking, right? Almost to the point where it can't possibly be true. I mean, if the top rate for a single person is 37%, and that rate doesn't begin until he has more than $510,000 of taxable income, how can he pay a higher rate with much less income? It doesn't make any sense. But here's the thing, it doesn't have to. It is the tax code after all. Later, I will explain more about why Bill faces that tax bill, but for now, the important thing to realize is that when it comes to taxes, the obvious answer is not always the correct answer. Our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you have been in the accumulation phase of your life for several decades, and you have been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you are in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach 72, you will have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. So that brings us to a simple statement about the problem we are here to discuss. Simply put, people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms: stocks, bonds, real estate, pensions, 401ks, IRAs, and more. In the distribution phase, your regular wages stop coming in. You have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you will need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. Poor choices through misunderstandings or ignorance of the rules can result in people paying more taxes than necessary. As a result, they may see their savings drop faster, and that can mean less to leave to the kids and the grandkids. Of course, we don't want that to be you, and the fact that you are here means to me that you are willing to work toward a solution, which is an important first step. Because your tax exposure will change throughout 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, and penalties related to Social Security, Medicare, and other income sources. That means you will need an informed and proactive plan that addresses how you create your income in retirement. Our goal is to introduce you to the major aspects of such a strategy and show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the types of taxes you may face. What do I mean by taxes? I'm talking about all of the costs that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as your income rises, it's a tax in my book. You also need to understand the retirement expenses you will face, and you will need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions should occur. Getting this right will help you pay as low a tax rate as possible. Before we go on, here are our 4 stages of retirement we'll discuss. These are rough ranges and descriptions. Your experience may differ. This is just a framework for discussing our topic. First, there's pre-retirement, the final work and save years of 50 to 60. Next, the early years of retirement, 60 to 70, the go-go years. People often have grand plans for this time, like traveling, volunteering, starting new hobbies, working part-time, and spending more time with family. Next, you reach the middle years of retirement, 70 to 80, the go-slow years, which bring more financial decisions such as how to deal with required minimum distributions from your IRAs and other retirement accounts. Finally, there's the latter years of retirement, when your health may not be as good and you're thinking about your legacy and estate, the no-go years, starting around age 80. As you will see, there are a wide range of issues that must be planned for in each phase, and this can be a lot harder than it seems, because retirement is full of surprises, and even the best planning will divert from reality at some point. One future unknown is inflation. People tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. Think back 30 years ago to the cost of a gallon of milk, or a gallon of gas, or a visit to the emergency room. Now think about those costs today and what they will grow to over the next 30 years when you are not working. That is inflation. Or how about your longevity? Many people end up living far longer than expected, and that requires more money at a time when it is difficult to work. How long do you think you will live? Many people also underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to see their standard of living drop? And then there are healthcare costs, the 10,000-pound gorilla. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which keep rising. Now at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance is not really $500,000. The government has a claim on part of that money because the taxes were deferred. They will get their share when you are forced to start your required minimum distributions after you turn 72. Obviously, the higher your tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is important throughout your retirement. Please take a moment to read the disclosure at the bottom of this slide. Now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I will have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps that you need to plan for as well. Let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on a concert road trip. Remember, Bill has $38,000 of IRA income, part of his adjusted gross income of $56,525, and he has $25,000 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a 41% marginal tax rate, $407, on that $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You see that in after concert trip column, he has $39,000 in IRA income. So we see here that by adding the additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he is being taxed on $1.85. Huh? How? Here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to a 40.7% real tax rate on the additional $1,000 income. That's the so-called Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is important. Let's look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go year stage, some people retire altogether, but other people enter into a sort of semi-retirement. Sometimes it's a continuation of a previous job, just with fewer hours. Others use semi-retirement to explore an interest in a new field. Still others use semi-retirement to pursue non-paid, rewarding volunteer work. So working in retirement can impact your planning and taxes in a number of ways, some good, some bad, and some downright ugly. Let's look at how working during these years can be a good thing. Chances are you have researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Well, what if you started working late in life? Or what if you left work to raise children? You may not have 35 years of earnings history. Suppose you only have 28. The remaining 7 years count as big, fat zeros when they calculate your benefits. But there is good news. Earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates benefits, replacing several years of zeros with even modest earnings can positively impact your benefits. Now let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies prior to reaching your full retirement age. Here's how the rule works. If you start Social Security, be it your own retirement benefit or spousal benefits, prior to the year you reach your full retirement age, for every $2 above a certain amount that you earn, $18,240 in 2020, Social Security will withhold $1 of benefits. Keep in mind that we are talking about earnings here, like a W-2 salary or self-employment income, not pensions, interest, dividends, and capital gains. They do not count and will not reduce early Social Security benefits. For instance, let's say that you earn $20,240 in 2020. That is $2,000 over the limit. Therefore, under the dollar withheld for $2 earnings rule, Social Security would withhold $1,000 of your 2020 benefits. But these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a bit higher. Also, in the year you reach full retirement age, there's a separate, higher earnings limit. Okay, we've talked about the good and the bad, so now you get the ugly. We are here to talk about taxes in retirement, but there are other taxes that you may face too. For instance, while you're working, you are subject to the 7.65% Social Security and Medicare taxes, in addition to income tax. The self-employed pay twice that amount, 15.3%, to cover the employer's contribution. Now, these taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. Worse, if your go-go years earnings don't make it into your top 35 years, those Social Security taxes go into the trust fund and don't increase your benefit. Now, let's take a look at how Medicare and something it calls IRMAA can impact some couples in the go-go years and beyond. First, what is IRMAA? It stands for Income-Related Monthly Adjustment Amounts. The emphasis is on income because it is a monthly tiered surcharge, again, a kind of tax, that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $87,000 for singles and $174,000 for married couples. Let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $271,000 of modified adjusted gross income, or MAGI, in 2018. But on December 1st, George decided to sell a stock he bought for $10,000 on July 1st, 2007. He sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So, George and Martha owe $188 of tax on the gain from their sale of the stock, right? 18.8% of $1,000. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then, George and Martha will owe more tax than $188 because the gain from the sale of stock pushed them off the Medicare IRMAA cliff into paying higher Medicare premiums. Let's take a look. Look at this Part B IRMAA chart. That extra $1,000 gain pushed their AGI into the next premium tier that starts with $272,001. So now, instead of owing $289.20 each for their monthly Medicare Part B premiums, George and Martha will each owe $376 per month, an extra $86.80 per month, times 2, $173.60 for an annual total in income-related monthly adjusted Medicare Part B premiums of $2,083. But it's not over, because Medicare Part D IRMAA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans, an extra $461 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about an extra $100 a month, or about $2,500 for the year. Now, combine that amount with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $2,732. That is a tax rate of 273%. Let me repeat that. That is a tax rate of 273%. Let's do a quick review. They sold stock for a $1,000 income gain. The stock sale tax was $188, 15% for long-term capital gains, and 3.8% for the net investment income tax for high earners, for an 18.8% rate. The extra income from the stock sale triggers new IRMA tiers. The total IRMA surcharges amounts for the year to $2,544 for George and Martha. So the $1,000 extra income triggers taxes of $2,732, 273% real tax rate. You see, being pushed into a higher Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Keep in mind, your IRMA payments are not determined by how much money you made the previous year, but rather your magi from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you will get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And, thanks to the way Medicare enrollment periods work, they were not able to begin coverage until the next year. In a worst-case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best-case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates to in real dollars. They owe $347 extra in 2020, and historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow. Over the course of a lifetime, that could translate into a $10,000 mistake for the couple. For simplicity's sake, we are assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that too. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So, if you're like some who've seen this presentation, you may be asking yourself, wow, are there other tax traps we will face in retirement? Well, the rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo or the Medicare IRMA cliff. The public generally is not aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You cannot be haphazard about tapping your tax-deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you will encounter unintended tax consequences. Let's take a look by first addressing a question we hear often when doing retirement planning. Which accounts to spend first? Here's a common example, Sam and Mary. They have been good savers, as you can see, and are looking forward to spending their retirement years traveling and seeing their grandchildren. In addition to Social Security benefits, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, $300,000 in a joint bank account. They want to spend about $8,500 a month, or just over $100,000 per year. Where would you take money from first? Most people think first take the after-tax money in the bank, then take the tax-deferred IRA money, and then take the tax-free Roth IRA money. This is conventional wisdom. It has been promoted by many big investment firms for some time. It's not a bad plan, but we know conventional wisdom is not always the best approach. Not surprisingly, this topic has drawn the attention of academic researchers specializing in financial planning. They have conducted multiple studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs and pensions, and tax-exempt Roth accounts. You can see some study titles there. Their research has shown that the conventional wisdom approach probably isn't ideal. Here, in an alternative approach, there are two key elements in the early years. First, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low-income years, putting that money into Roth accounts. This is the filling your tax bracket approach, which we will discuss in a second. This alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. Does it make a big difference? I think so. In the academic studies, this approach has been shown to increase portfolio longevity. That is how long your non-Social Security assets last before being totally spent, by up to 2 years. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets. And of course, see your tax professional for tax advice. One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your tax professional. A conversion doesn't need to be all or nothing, though. One helpful conversion approach is called filling up the bracket. Often, you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2019, the 22% tax bracket for married couples filing a joint return went from about $79,000 to about $168,000. If you file a joint return and your taxable income is $100,000, that means that you could add another $65,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. Roth IRA conversions can be especially powerful in years when your taxable income is low, such as having a high non-recurring medical expense deduction or a low sales year for a business owner. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making it a good time to complete Roth IRA conversions in those pre-RMD gap years. So this is a good time to spell out the crux of things. You must know whether you are trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate. Some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, or taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There are also two other pre-retirement strategies to consider, but they don't apply to all people. The first has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible health plan, HDHP. The second has to do with high-earning small business owners who fund company pension plans and become eligible under the new tax law for something known as the Qualified Business Income, or QBI, deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax-favored benefits throughout retirement. If either or both of these apply to you, note that and please share them in your questions to us. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts, because once you're over 72, you're forced to take out required minimum distributions, or RMDs, and that can be troublesome to your tax bill. But many people make charitable donations, supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the new 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2020 is $24,800. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2020 to roughly $27,400. This means they will receive no tax benefit for any itemized deduction unless their total exceeds that $27,400 mark. So, if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, and mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit from making the charitable contribution because it does not exceed their $27,400 standard deduction. That's not to say they shouldn't do it, but they should understand it is not helping them save on taxes. Now, if you're over 70 and a half and have an IRA or inherited IRA, there is another way to give to charity than simply writing a check. It is called a Qualified Charitable Distribution, or QCD for short. Let me explain how it works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make count toward satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive a check from your IRA custodian made payable to the charity. Third, This is the odd part. Even though you gave to charity, you get no income tax deduction. So why would we suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. He is done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? But let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200, or $6,200. Remember, the gift did not impact their standard deduction. The RMD behind the gift just added to their income. Ouch! Now let's see what happens if Albert and Shirley used the QCD way to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly RMD. Now the charity is in the same position as before. They receive a $5,000 donation. A good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity. Even though they receive no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage. And they did it all without ever getting a deduction. But we all know charity starts at home, so it's a natural question to ask, how does retirement planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters, which leads us to our final key, number 4. Organize your assets for your family's benefit. Estate planning still matters. Estate planning is always a relevant topic, even though people do not like to discuss death. But we're not going to discuss it in the traditional way. That's because the new tax law excludes estates valued at up to $11.4 million from the federal estate tax, meaning only the tiniest fraction of people need to worry about estate taxes. Note, you may still face an estate or inheritance tax at your state level. Still, very important tax issues remain around how your assets are received by your beneficiaries after you die. One example is making sure married couples plan for their available step-up-in basis. That's quite a tax term, right? Simply put, a step-up-in basis is a tax rule that readjusts the value of an inherited asset so its value is not what your spouse or decedent paid for it initially. Instead, it's stepped up to its price on the date of death. This can make a big tax difference, as we'll see. It's likely that most assets you own, other than your retirement accounts and annuities, will be eligible for a step-up-in basis. Let's consider Phil and Mary, who live in a separate property state. They are married and own a variety of taxable investments in a joint account known as joint tenants with rights of survivorship. And the investments have long-term capital gains of $120,000. One day, bad news arrives. Phil is diagnosed with terminal cancer. He has 18 months to live. Let's see how this works with two scenarios. In the first, Phil and Mary make no planning changes to their assets. When Phil dies, Mary will receive a step up in basis on Phil's half of the joint account, which is $60,000. She will still face a future $60,000 of unrealized gain on her half of the account. Simply put, that means if Mary decides to sell all the assets, she will owe tax on her $60,000 of gain. Now suppose that upon Phil's diagnosis, Mary and Phil moved all the investments into one account in Phil's name. Then, as long as Phil lived longer than 1 year, Mary would receive a full step-up in basis on the entire $120,000 account. Simply put, Mary could sell that account and pay no tax. When you sell your investments, would you rather owe tax on $60,000 of gain or none? And let me say, planning around death is hard, but this is where a professional can help because they are emotionally removed from the situation and can assist you to make good decisions that may seem hard at the time. Now, maybe you are someone who has managed to save up quite a bit in your IRA or 401k. You feel pretty confident that you'll be comfortable in retirement and are hopeful that you will leave behind the account to your children. In the past, we would have recommended that because with the right structure, your heir could withdraw the money throughout their lifetime, possibly decades. That changed with the passage of the Secure Act in December of 2019. Now beneficiaries of inherited accounts, with some exceptions, must withdraw all of the money within 10 years of the owner's death and pay taxes on that money. This restriction on what was called stretch IRAs shines a light on how important tax planning is. Laws can change at any time, so you need to have a plan and revisit that plan regularly. If you would like to learn more about the Secure Act and how it could affect your retirement savings or estate plan, make a note of it, and if we sit down with you for a meeting, you can ask about your particular situation. I'm going to skip through the next few slides as they illustrate a strategy that is no longer valid. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you are receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they do not exceed the higher of your actual long-term care costs, or an IRS daily limit, currently $360. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often, the first inclination of the insured here is to tap the policy to pay for long-term care costs, but that's often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note, this is just an example and is not meant to represent any specific policy, but many long-term/life insurance hybrid policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she will have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000 to $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for the long-term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. And now, the kids will inherit the $500,000 of life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question. Let's bring it all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it is critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in low tax years. We also looked at Social Security and taxes, plus the importance of couples having a benefit strategy that considers the surviving spouse. And we saw Medicare has its own tax-light structure that can push you off the IRMA cliff, and we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you will be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All of those items together lead us to this obvious solution to our original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap assets to cover your personal expenses, understands the range of taxes you will face at various stages, manages your actions so you pay as low a tax rate as possible. By participating in this workshop, you're indicating that you're preparing to leave the accumulation phase, saving for retirement, and moving to the distribution phase when you start spending retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education and planning and advice. It is a lot to think about. Our tax code is complex, and the rules keep changing. But what does not change is that you need a plan. We can help you get started with creating a retirement tax planning strategy, or give our analysis of your current strategy if you've already started. In your one-on-one meeting with one of our advisors, either Lance Scott or John Moran, his co-advisor and a certified financial planner, you will discuss your retirement and savings needs and the role taxes play. That meeting will consist of identifying where you and your family stand in regard to preparing for retirement, reviewing your timeline, and identifying key retirement planning and tax issues you need to anticipate. Coming out of that meeting, our firm can act as your resource and help you find the right people to assist you in specific tax advice if needed. Naturally, we can help you with the key financial planning and investment advice that relates to your situation too. Regardless, when you leave your meeting, you will be better informed about your retirement planning needs and what to consider doing next. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind knowing that you've got a plan for making the most of your retirement accounts. So if you have not already, please contact our office to schedule your complimentary consultation. And please continue on to our second follow-up webinar session, the New Tax Law Briefing, that does a deeper dive into the new tax laws and how they might affect you.